let's talk medical deductions. You know, I hear from accountants all the time that they don't know how to discuss things like this with their clients and still get them excited about the possibilities of tax planning. For that reason, I'm going to explain this strategy just how I would explain it to my clients to give you some ideas. The bottom line is be honest, be energetic, and be excited about the tax savings, and they will be too. One of the biggest and most unpredictable expenses that individuals and families can have are medical expenses. Now with insurance, you might be able to handle the co-pays and yearly checkups, but what about any major medical issues that could arise? Or of all the things that regular medical insurance doesn't cover, like orthodonture, over-the-counter medicine, laser eye surgery. Here's what you need to know about medical deductions. Yes, they're deductible, but to what extent? So as advisors, our role here is to help people make the most of those medical deductions and pick up some that they might be missing. Any medical expense that is paid for the diagnosis, cure, or mitigation for the treatment or prevention of a disease is deductible as long as it's for any part or function of the body. Equipment, supplies, and diagnostic equipment as well counts. So the idea here is to get much more familiar with your client's expenses. They might not think to even communicate with you about some of the deductions we're going to be talking about today. So there's really two components. Number one is boosting the things that they're not currently deducting, and number two is the vehicle with which you're able to deduct even more. Now there's a lot of medical devices and treatments that just are generally beneficial to health, and those things are not deductible either under traditional insurance, and they typically are not deductible under the medical rules from the IRS. Things like vitamins or even a vacation, unfortunately, are just not deductible. Here are some things that regular medical insurance may or may not cover where we can pick it up as a tax deduction. Things like co-payments, prescriptions, hospital care, meals, although special rules apply, nursing care facilities, and special equipment like telephones, televisions, or even mobility devices. Now, in certain instances, weight loss programs can be covered by insurance if they're for a specific disease diagnosed by a doctor. And if they're not covered by an insurance, you might be able to deduct them here, although you can't deduct food and beverages that substitute for what your normal nutritional needs are. You can deduct food that doesn't satisfy your normal nutritional needs as long as it treats an illness and the need for that specific food or beverage is substantiated by a doctor. In general, though, it's very tricky to be able to deduct any kind of food related to a weight loss program. I'd like to talk about some more creative ideas, though, and how you can boost these deductions. How about expenses for things like massage, swimming pools, jacuzzis? Even clarinet lessons and ballroom dancing lessons can be considered a deductible medical expense, just not the costumes for the ballroom dancing. Some things that are not deductible are babysitting, childcare, nursing services for a normal, healthy baby, things like controlled substances, cosmetic surgery, hair removal or electrolysis, funeral expenses, and unfortunately health club dues are also not deductible. Now, it's common knowledge that most people have medical insurance, but this is where a lot of accountants fall short. And so in the planning realm, we're trying to go beyond that to look for tax savings ideas. So while they may be either deducting those insurance premiums pre-tax through a paycheck, for example, they may also be deducting those premiums as a 4 AGI special deduction on that 1040. But like I mentioned, there are lots of things that aren't covered by insurance that can really add up, and we sometimes take those things for granted. Now, the timing is important here because you can only include the medical and dental expenses that you paid this year but generally not payments for regular medical or dental that is for care that you're going to receive in the future. Now, there are exceptions when someone passes away that allow you to continue to write off those expenses as you pay for them after the fact. Let's talk about the vehicles here, though. The vehicle is where we're going to deduct it on the tax return. And it's not uncommon knowledge that we can take medical expense deductions on Schedule A. However, we're limited to deducting amounts beyond 7.5% of our adjusted gross income. And who wants to lose out on 7.5%? But it's one option. So you could deduct things like your copays, your prescriptions, your hospital care, etc., but you're going to lose automatically that 7.5% for your adjusted gross income. Now, I mentioned self-employed health insurance premiums get deducted on the front page of a 1040 as a special for AGI deduction. But those self-employed health insurance premiums are not deductible for calculating self-employment tax. We'll come back to that in a moment. Medical expenses are a fringe benefit, so it's something you can offer yourself if you own a C corporation, or you can use the hire your spouse loophole and implement an employee benefit plan within a sole proprietorship or a partnership, for example. Let's talk about S corporations because they're a special animal here. Medical expenses are deductible by the S corporation, even if that policy is in the name of the beneficiary, so the owner of the business as an example. When that health insurance is paid on behalf of a greater than 2% shareholder of the business, it gets deducted by the corporation and then needs to be reported as wages on the business owner's Form W-2. It is eligible for that special above the line deduction. And when the shareholder must purchase health insurance in their own name, it's still deductible. Don't worry about that. Let's talk about sole proprietorships, though, and partnerships. Here's the problem with these types of business entities when you have non-taxable fringe benefits. Number one, these are fringe benefits, and they're not allowed for the self-employed. So if you are a sole proprietorship or a partner in a partnership, you are considered to be self-employed, and therefore it is not deductible. So one strategy to get around this, or a loophole if you will, is if the business owner is married, have them hire their spouse. Now, there's rules that you need to follow with that, so check out our class on hiring family. But by hiring the spouse, you can implement that employee benefit plan, which is going to cover the spouse and their family, which includes the owner of the business, and that's how you can get that as a deduction. Now, the rules for deducting medical expenses through an employee benefit plan can get complicated depending on what entity structure is used to hold the business. So I put together this chart. You might want to push pause so that you can read it, where I've listed out each entity type and the method or the mechanics of how to implement the tax strategy. As an example, if you want to be able to deduct an employee benefit plan that covers tax-free medical benefits, and you have a sole proprietorship, the owner would need to hire their spouse in order to be eligible to make that deduction. Now, the rules can get complicated, and you really do have to hire the spouse to work in the business. So check out our course on hiring your family for more details. The same thing is true with a partnership, but only if the spouse is less than a 5% owner. If that's the case, now you can hire the spouse to work in the business and implement the same employee benefit plan. Now, S corporations are a strange animal, and unfortunately, when you're a greater than 2% shareholder in an S corporation, you're ineligible to deduct an employee benefit plan. Now, unlike the proprietorship and the partnership, the hire your spouse loophole won't work here. And the reason is because in S corporations, we have something known as the attribution rules that kick in. When we have a married couple and one spouse owns the S corporation, that spouse's ownership attributes to the other spouse, and therefore they're both considered to be greater than 2% shareholders and therefore ineligible for this employee benefit plan deduction. So an alternative is the C corporation. The C corporation has many benefits, one of them being that you don't even have to hire your spouse. You can simply implement an employee benefit plan that deducts your medical expenses just for employing yourself within the C corporation. Now, in C corporations, I mentioned that employee benefits are usually tax deductible. I say usually because what we're looking for here is reasonable compensation. Let me give you an example. Let's say that a spouse is working for the C corporation and there's an employee benefit plan. Let's say the spouse does 10 hours of work per year, and the employee benefit plan reimburses $80,000 worth of tax-free expenses. That's probably not reasonable for the work that was done by the spouse. And in that case, the fringe benefits might not be deductible. So just remember, this is compensation, and it does need to be reasonable for the work that's being performed. Otherwise, the IRS can come in and reclassify those payments as dividend, which is going to make tax go up, which is the other direction. Now, there's lots of IRS research behind these types of medical plans and what kinds of expenses are deductible and are not deductible. And we also look at different court rulings to establish some of the more creative ways of introducing medical expense deductions. So when we talk about deducting things like clarinet lessons for your daughter, that case referenced a parent who was paying for clarinet lessons for a daughter whose orthodontist recommended those lessons for treatment of an overbite. We get into something like ballroom dancing, and the court case refers to a woman who was elderly whose doctor wrote a letter and recommended the ballroom dancing as a treatment for arthritis. So do you see how that works? We have an expense, and as long as that expense is attributable to the diagnosis or treatment or prevention of a body illness, then it becomes a deductible medical expense. Now, the rules can get complicated on what types of supporting documentation you need in order to be eligible to take these expenses as a deduction. So be sure you refer to these different IRS publications so you can have the proper documentation system in place. Now let's talk about the vehicle. We know we can report those deductions on Schedule A or as an above-the-line deduction for self-employed health insurance premiums, but employee benefit plans give us an opportunity to deduct up to 100% of that out-of-pocket expense. We can do it as a direct reimbursement or a direct payment to the provider. It could be done under what's called a health reimbursement arrangement, which is what I'm going to be talking about. It is offered as a contribution on behalf of the employees. There's also something called an FSA, or flexible spending arrangement, cafeteria plans, and health savings accounts that we'll get into now. Each one of these vehicles gives us the legal method of being able to make those deductions, and it's also the place where you're going to recognize those deductions on the tax return for compliance purposes. A little bit about the fine print though before we go further, and that is that we have to be careful in not discriminating against other non-related employees of the business. So let's say you have a sole proprietor, they have 3 non-related employees in the business. The owner may also be required to offer the same employee benefit plan to those other employees, or else it could be deemed as a non-deductible expense. Now, you don't have to be fair, but you just can't discriminate. However, you can exclude employees who are under the age of 25, who work less than 35 hours per week, or less than 9 months per year, or folks with less than 3 years of service. You should also be aware of the controlled group rules and the affiliated service group rules, which are there to prevent a business owner from simply starting a new business with themselves being as the only employee, simply to avoid providing benefits for the other employees of the other business. Now let's talk about Section 105 plans. There's many names for this type of plan. You may have heard it referred to as a health reimbursement account, or HRA. It's also known as a medical expense reimbursement plan, or MERP for short. But essentially what a Section 105 plan does is it allows a business expense deduction for all covered medical expenses. And those expenses can be reimbursed to the patient or paid to the provider themselves. So anything for the employee themselves, for their spouse, and also for their dependents, depending on how the business owner wants to design the plan. The beauty here is that it's a 100% business deduction, and you avoid the 7.5% of AGI floor by using this as an itemized deduction. So do you see how it can really boost those write-offs? It also helps you reduce self-employment tax because this is a deductible expense in calculating self-employment income. It is also eligible to be used even when the spouse of the business owner has coverage themselves. Some of the eligible expenses you should be aware of in a Section 105 plan are any major out-of-pocket medical expense, long-term care insurance premiums, Medicare, and even Medigap insurance are deductible through the medical expense reimbursement plan. Copays, deductibles, prescriptions, even things like fertility treatments and LASIK eye surgery. So to go back to our definition of deductible medical expenses, these are the same types of costs that we deduct through an employee benefit plan. This is a list that I've put together from A to Z of all the many things that are covered. You might want to push pause because the list is really mind-boggling on how many things can be covered, and it makes you wonder how many people are not doing this. Again, it's anything for the treatment or prevention of or the diagnosis of a disease or illness in the human body. So things like eyeglasses, orthodontia, oxygen, even over-the-counter drugs, so long as you have a letter from a physician, can be included as a reimbursable expense, which makes it deductible to the business and non-taxable to the recipient. You can significantly increase the amount of tax savings the more expenses you're able to deduct. Now let's talk about the paperwork. You do have things required because this is an official employee benefit plan. So a written plan document is required. Benefits must be reasonable compensation for the employee's work that's being performed, and they do have to really work in the business. So if you're curious about what that looks like, check out our class on hiring your family. You want to document your payments, and you want to make sure that you're following all HIPAA law requirements. And because of these levels of complication, just as an example, let's say you're reimbursing a non-related employee, there are HIPAA requirements that provide privacy for the employee. Yet, as the owner of the business, you have to have documentation to make it a tax-deductible reimbursement. So what is a business owner to do? For that reason, I recommend hiring a third-party administrator to administer your plan. They provide the written plan agreement, and they handle the reimbursements, the tracking, and the required documentation and accounting to go along with it so that the business owner doesn't have to be hassled. Now, let's say that a medical expense reimbursement plan is not ideal for your client. The next best thing, in my opinion, is going to be the health savings account, or the HSA. And that again is because of how much coverage it provides in giving you the ability to deduct 100% of your unreimbursed medical expenses. Again, it covers things that I've talked about before: major medical, Medigap insurance, co-pays, deductibles, prescriptions. By now you know the drill. The way the HSA functions, though, is different from the medical expense reimbursement plan. The way the HSA works is you make a tax-deductible contribution to a special kind of savings account. That amount is deductible that year from your taxes, and then as expenses come up, you can submit for a reimbursement that becomes tax-free withdrawals from that savings account. Now, one other arrangement to be considered here is the flexible spending account, or what's known as an FSA. With the FSA, it's a special account that you set aside money in every year. The major difference between this and the HSA, though, is that you're estimating what you believe your expenses will total for the year. And sometimes that can be hard to do. There are limits on how much you can deduct through a flexible spending account, and that limit is here on the screen. I think the biggest disadvantage of the FSA is that if you don't use all the funds in the account by the end of the plan year, you actually lose that benefit. It's partly why you see all those commercials on TV talking about spending money on getting these things done now. One newer rule is that you can roll over $610 into the next year, and that prevents you from losing all of your money. But it can be difficult to pinpoint exactly what you believe you'll be spending throughout the year so that you can get that tax-free reimbursement. I hope this helps gives you some ideas on how to share this with your clients and get them eager and excited about working with you to save tax. If you're interested in learning more advanced tax reduction strategies or how to implement tax advisory services in your practice, check out the link on the next screen.